If you still think economic crashes are random disasters that hurt everyone equally, then you are looking at the event from the wrong side of the glass. That is the first thing I want to tell you. A crash is not only destruction. A crash is a transfer window. It is the moment when one class of people is forced to sell time, patience, property, and future cash flow to another class of people that prepared for the event before it arrived. That is the mother line of everything I want to say. The people who build the largest fortunes during collapses do not begin their work when the index is already down 30%, when the anchor on television looks terrified, or when the public starts speaking about buying the dip as if courage alone could replace structure. They begin long before that, 18 months before, sometimes 2 years before, sometimes earlier. They begin when everybody else still feels fine. That is why the mainstream story is so useless. The mainstream story tells ordinary people that crashes are unknowable. Diversification is enough, and staying fully invested is the only morally respectable way to move through every cycle. That advice is designed for a certain kind of person. A person without structural access, a person without size, a person without the freedom to move capital early without attracting attention, a person who must survive average outcomes because he cannot build a custom response. The truly rich do something else. They do not panic at the crash. They prepare for the transfer window. They begin collecting assets that survive the event better than paper wealth does, assets that become more powerful when other people are desperate, and assets that allow them to buy what panic throws overboard. That is the playbook. And once you understand the playbook, you stop looking at crashes as punishment from the sky. You start seeing them as scheduled shopping periods for prepared capital. I learned long ago that the market is not mainly a morality play. It does not reward good intentions. It does not reward optimism. It does not care how deeply you believed in the long-term promise of the system if your structure was wrong when the sequence turned against you. What it rewards is preparation. That is why I care less about the exact month of the next crash than I care about where capital is standing when the shadow of it begins to fall. That shadow always appears first. The people who recognize it do not become emotional. They become liquid. That is the first mechanism. I call it ammunition. Most people treat cash as if it were an embarrassing confession, something to apologize for in bull markets, something that earns too little, something that means you missed the upside everyone else is celebrating. That is amateur thinking. The wealthy do not treat cash that way before a downturn. They treat it as ammunition. And ammunition is not judged by what it earns while the battlefield is quiet. It is judged by what it allows you to buy when everyone else is bleeding. I have watched this over and over again before major dislocations. The people with the most discipline are not buying the loudest story. They are quietly accumulating dry powder in the dullest instrument available. Short-duration government paper, treasury bills, cash equivalents, highly liquid sovereign instruments. They are not doing this because they became timid. They are doing it because they understand that optionality is more valuable than incremental yield right before assets are forced into sale. That is the first divide between ordinary investors and capital allocators. The ordinary investor says, "Why would I hold cash while the market is still going up?" The allocator asks, "What is the value of being able to buy everything when everyone else cannot?" That is a different level of thinking. A person with $10 million in short bills before a severe sell-off is not underinvested. He is armed. He may be earning less than the index while people around him congratulate themselves for being fully exposed. Fine, let them congratulate themselves. When the market falls 40%, when good businesses become hostages to liquidity, when debt-funded owners are forced to hand over what they swore they would never sell, the man with bills and cash equivalents has something the market always worships in a crash: immediate purchasing power. That is what ammunition means. It means you are no longer merely surviving the event. You are positioned to acquire from it. People do not understand how dramatic that difference is. During the good years, cash looks passive. During the transfer window, cash becomes the most aggressive asset in the room because it can transform into every other asset at distressed prices. That is why I never laugh at boring money before a hard cycle. Boring money becomes imperial money in the right month. Now let me take you to the second mechanism, because this is where the game changes from defense to legal capture. I call it ownership through debt. Most ordinary investors still think of debt as the thing you avoid or the thing you use carefully. Fine, they are not wrong. But the really sophisticated capital does something else. It waits until someone else's debt becomes the doorway to ownership. This is where distressed debt matters. When a company is in trouble, its equity often becomes a theater of hope and denial. Public shareholders tell themselves the stock is cheap because it is down. Analysts speak in soft voices about recovery possibilities. Message boards fill with amateur heroism. Meanwhile, the real value is shifting somewhere else entirely. It shifts into the debt, because in distress, debt is not merely a loan. Debt becomes a legal claim on the company itself. That is the part most people never understand. If you buy a troubled company's bonds at 15 cents or 20 cents on the dollar during panic, you are not simply betting on recovery. You are positioning yourself in the legal waterfall. If the company restructures, old equity often gets destroyed. Debt holders move up. In many cases, they emerge with the reorganized equity, the assets, the contracts, the routes, the properties, the real business that was hidden under the public wreckage. That is why distressed debt is so powerful. It is ownership in disguise, and it is one of the cleanest examples of how wealth is transferred during crashes. The middle class sees a company fail and thinks everything is gone. Sophisticated capital sees a company fail and asks, who sits highest in the legal queue when the old claims are wiped out? That is a brutal question. It is also the only one that matters if you are trying to understand how fortunes are built in downturns. I have enormous respect for people who mastered this. They are not buying despair because they enjoy suffering. They are buying legal priority. They are converting other people's financial collapse into below market ownership of productive assets, warehouses, shopping centers, routes, service contracts, industrial plants, logistics networks. All the things the old equity once claimed to own but could not protect when the structure cracked. And notice what this means. A crash is not simply a period when prices fall. A crash is a period when the ranking of claims becomes visible. That is why I call it a transfer window. Not everybody loses equally. The people standing higher in the structure emerge owning what the lower people financed emotionally and lost legally. Now, most ordinary investors cannot access distressed debt directly in the same way large funds can. Fine. The exact vehicle is not the only lesson. The deeper lesson is this. Wealth is often transferred not by guessing what stock will recover, but by understanding which legal claims survive the destruction of the old capital stack. That principle is worth a fortune, even if the specific instrument remains outside your reach. Now let us move to the third mechanism. I call it the caloric claim. This is farmland. And when people hear that, they often make two mistakes. They either romanticize it as if it were some quaint rustic thing, or they dismiss it as something only billionaires with maps and lawyers can care about. Both reactions miss the actual point. Farmland is not interesting because it is charming. Farmland is interesting because it produces calories. That is a very hard floor under value. A shopping center can lose tenants. A growth stock can lose believers. A luxury apartment can lose speculative premium. A bond can lose purchasing power. But land that produces food sits much closer to biological necessity. It serves a demand line that does not vanish because the credit cycle turned ugly. That is why serious wealth has always gravitated toward productive land in periods of monetary stress and social disorder. This is not modern genius. This is old knowledge across centuries. Whenever paper systems became unstable, people with real liquidity and strategic patience found ways to acquire the ground that fed populations. Rome did it during debt dislocations. Europe did it after plague and war. Industrial families did it when currency systems turned treacherous. Wealth does not need to invent the playbook each century. It simply dresses the same instincts in new legal wrappers. The instinct is simple. Own the thing people cannot stop needing. Calories are very high on that list. Farmland also solves another problem that older investors and sophisticated families care about deeply. It gives you a claim on a real asset that is not manufactured by central banks and not especially correlated to the emotional drama of daily financial markets that matters during a transfer window, because non-correlated real assets give you a place to preserve power while other people are trapped in paper volatility. And there is another layer that most people miss. Not all land is equal. Land producing export crops or tied into real trade flows has a very different quality from land whose economics are completely trapped inside a collapsing local currency system. That distinction matters because what you really want is not dirt. You want productive capacity that either holds value locally through necessity or is tethered to wider demand beyond one wounded currency zone. That is what the richest buyers understand. They are not buying scenery. They are buying recurring necessity with a hard floor and long memory. Now we come to the fourth mechanism, and this is where the game becomes subtler. I call it private scarcity. The public market is where panic performs itself. Private markets are where wealth hides from the performance. Fine art, rare objects, truly scarce cultural assets. The kinds of things bought not at public auctions after everyone is excited, but through quiet private channels before the headlines become unbearable, operate very differently from equities. They are not liquid in the same way. They are not transparent in the same way. And that is precisely part of the attraction for the people who know how to use them. Most ordinary investors never understand this asset class because they keep viewing it through a consumer frame. They think the rich are buying paintings because they enjoy paintings. Sometimes they are, but serious capital does not allocate meaningful sums for decoration alone. It allocates because certain scarce objects carry three extremely valuable properties at once: finite supply, low public correlation, and the ability to move privately through relationship networks rather than through public tape. That combination matters in a transfer window, when public markets become chaotic, when everyone can see the panic in front. Run the obvious trades. Private scarcity gives wealth a way to preserve itself outside the emotional stampede. The point is not that a painting will save civilization. The point is that truly scarce assets cannot be printed, diluted, or margin called into existence the way financial assets can. Scarcity takes on a new dignity once central banks start behaving like magicians and governments start behaving like debt addicts. That is why sophisticated families and funds increase private transactions in scarce cultural assets before major downturns. They are not becoming whimsical. They are becoming non-correlated. That distinction is huge. A piece of blue chip art properly acquired is not a stock with pretty colors. It is a unit of scarcity with no issuer. That matters more than people think. The public ignores this because it has been trained to think only in brokerage, account categories. But money that thinks across generations often wants something outside the daily scoreboard. That is what private scarcity provides. And again, you may not access it in exactly the same way as a family office. That is not the main lesson. The main lesson is that serious wealth seeks assets whose value cannot be manufactured by the same system it no longer fully trusts. Now we arrive at the fifth mechanism. This is the one that really matters. I call it inescapable cash flow. Because if the first four assets are ways of preparing for the transfer window, the fifth is how new empires get built once the window opens. What kind of businesses does rich capital want when the economy is contracting? Consumers are stressed, lenders are wounded, and optimism is scarce. Not glamorous businesses, not disruption stories, not whatever was exciting when money was free. It wants businesses tied to behavior people cannot stop: waste removal, storage, funeral services, pest control, water, medical waste, the ugly ignored, necessary machinery of life. This is the greatest joke in capitalism. The crowd falls in love with glamour during expansions and then loses fortunes when glamour depends on conditions that no longer exist. Quiet capital does something else. It waits until stress reveals which businesses continue billing no matter what story the economy is telling about itself. Those businesses are not romantic. They are unavoidable. Garbage still gets collected in recessions. people still die in recessions. Mice do not respect the yield curve. Storage demand often rises when households shrink, break, move, or are financially squeezed. Medical waste does not disappear because the SP is down. Water remains water. These are not optional sectors. They are the plumbing of social existence. And that is why they are so valuable in downturns. Their demand is inelastic. Their local competition is often fragmented. Their contracts or routes can be acquired when smaller operators are too leveraged to survive. And because nobody over-glamorizes them in bull markets, they are often available at valuations that do not require a fantasy future. That is exactly what you want in a transfer window. You want enduring cash flow attached to necessity, not hope. What makes this mechanism so powerful is that it is not merely defensive, it is offensive. These businesses often become platforms for consolidation in hard times. Weaker operators fail, routes get bought, customers get transferred, local monopolies get thicker, margins improve once the panic clears. What looked boring becomes wildly powerful because it never needed perfect conditions to function in the first place. That is how entirely new fortunes are built in downturns, not by being a genius on television, by buying the unignorable at the moment. It is unloved. This is the deepest lesson of the whole document. The rich do not mainly prepare for crashes by finding the perfect forecast. They prepare by standing near assets that become stronger when the rest of the structure gets desperate. That is what cash ammunition does. That is what distressed debt does. That is what productive land does. That is what private scarcity does. That is what essential monopolies do. Each one, in its own way, says the same thing. I intend to be a buyer when others are forced to become sellers. That is the psychology of generational wealth. Not panic, not commentary positioning. Now let me tell you the darker truth underneath all of this. A crash is not a neutral cleansing. It is a sorting machine. It takes assets away from people who needed the next month to look normal and transfers them to people who prepared for the possibility that the next 2 years would not. That is why the middle class experiences crashes as disasters and the ultra-wealthy often experience them as procurement cycles. One side is liquidating to survive. The other is acquiring to compound. That sentence may sound harsh. It is also how the system actually behaves. The question is not whether that is fair. The question is whether you understand it well enough to stop standing on the wrong side of it. This is why I have always disliked the bland phrase, stay invested, when it is delivered as a complete philosophy. It is not a complete philosophy. It is a decent survival instruction for people without other tools, but it is not the actual playbook used by people who build dynastic wealth. Dynastic wealth does not simply hold passively through every regime and hope the averages remain generous. It studies liquidity, structure, legal claims, scarcity and necessity, then arranges itself where panic becomes opportunity instead of destruction. That is a different game. And once you see it, you cannot unsee it. You begin recognizing the shadows before the crash arrives. Quiet increases in liquidity, quiet buying of short sovereign paper, quiet accumulation of non-correlated stores of value, quiet positioning in distressed credit, quiet interest in boring, necessary businesses. None of it looks glamorous in real time. It only looks obvious after the transfer window opens and the people who prepared begin shopping in public. That is how wealth works. It is not dramatic when it is smartest. It is boring when it is smartest. Now, I want to say something important for the ordinary investor because there is a temptation to hear all this and turn it into theater, to imagine you must become a master of secret instruments overnight, to believe there is some mystical hidden door only billionaires can use. That is the wrong lesson. The exact vehicles differ, the principles do not. Cash is still ammunition whether your account has 10,000 or 10 billion. The instinct to own productive necessity still works whether you buy a public company with dominant local routes or a private business. The logic of real assets still matters even if you cannot buy 10,000 acres. The lesson of legal seniority still matters even if you never touch distressed debt directly. The principle of scarcity still matters even if your expression of it is modest. The question is not whether you can copy a billionaire line for line. The question is whether you understand the transfer window well enough to stop being the one who finances it with your panic. That is the actual opportunity. Now let me bring this to the only question that matters. If the next crash is not a meteor but a predictable redistribution event, where do you want to be standing when it arrives? Do you want to be fully exposed to whatever was most expensive and most loved in the final euphoric phase, telling yourself you will just be patient if things turn ugly? Do you want to be leveraged, illiquid, and dependent on the market staying kind? Do you want to be holding a portfolio whose diversification disappears exactly when stress becomes real? Or do you want to be holding some ammunition, some necessity, some scarcity, some room, and some understanding of how the legal and economic machinery of distress actually transfers assets from one group to another? That is the real decision. Most people do not make it consciously. They drift into the wrong side of it. The drift is expensive. It always has been. So here is the final truth. Every major crash of modern history has been a window through which prepared capital bought the future from frightened capital. The names change, the headlines change, the central bankers change, the slogans change, the transfer does not change. That is why I do not treat crashes as unpredictable acts of God. I treat them as recurring opportunities for anyone disciplined enough to think like an acquirer before the crowd learns it must become a seller. That is what the wealthy have understood for over a century. And if you understand it now, then the next crash does not have to be something that happens to you. It can be the first time you recognize the window while it is still opening.